Hey guys, pretty thrilled today. I have the managing partner of Alignvest Student Housing REIT, Sanjil Shah, with us today. Sanjil, welcome.
Thanks, Rob.
We're going to talk about student housing as an asset class. We've had him on before. It's a really neat asset class, one that we own and one that we believe in for a whole bunch of reasons. There's a lot of talk right now about inflation, about debt, about what happens to schooling long term. So there's a lot of talk, negative talk about this asset class. But the numbers actually show the opposite. The numbers actually show that this has been one of the most resilient, fully leased, well-occupied, increasing NOI asset class in the real estate sector that exists. So let's get into it, Sanjil. Tell me on the maybe big picture, what does the REIT hold in terms of assets right now?
Sure. So we hold purpose-built student housing properties across Canada. We have 12 properties today with 5,200 beds. We're in 6 university markets across the country, going east to west. We're in Halifax on the east coast. In Ontario, we have 3 properties in Ottawa, 5 in Waterloo, Hamilton, Oshawa, and then we go as far west as Edmonton.
Okay, so how did you decide to get into student housing? Why was that a thing?
Yeah, so there's an interesting backstory there. So I've been in real estate for almost 20 years. Originally, I was in self-storage. Did that from 2003 to 2007. And really the genesis for getting involved in that was I was seeing what was happening in the United States with some of the trends in self-storage, right? There were several self-storage companies that went public in 2003, 2004, Extra Space, You Store It. In Canada, we were still kind of the sleepy backwaters where it was kind of the first gen, on the side of the highways, the mom and pop, pull-up garage doors. So we consolidated that sector. And what I learned from that is, Canada is kind of like a tenth of the size of the United States. And we don't have to reinvent the wheel. We can just see what's working in the United States, south of the border, what's been successful, what's been professionalized, where institutional capital has come in, and then do the same thing in Canada without having to make all of the mistakes that some of the US pioneers went through. And so over a 3 or 4 year period in the early 2000s, we did exactly that. We started developing self-storage facilities. We consolidated the market. We grew to become the second largest self-storage company in Canada, and then had a very healthy exit in 2007. Fast forward, I was then with Alignvest. Alignvest is a private investment firm based in Toronto. We've been investing our own capital off our balance sheet. I was itching to get back into real estate, but really looking for kind of niche real estate with an operational element. And if you have an operating real estate sector, you can really provide outsized returns by having operational efficiencies and excellence. So about 6 or 7 years ago, I came across the idea of student housing, and the parallels were striking. It was, it was a professionally managed institutional capital was flowing into this sector in the United States, but not only in the United States, also in the UK, parts of Europe, Australia, and in Canada. It was exactly what you said. It was mom and pop. It was a mom and pop sector, and so our thesis was, let's just do what we did in self-storage many years ago.
Do it with student housing.
Do it with student housing.
So that was 5 years ago, roughly, that you started. You now have a 5-year number on your student housing.
June 30th is our 5-year mark.
What's it going to be?
12%.
12% annualized over 5 years. How much of that is distribution?
So the distribution currently is about 4.5%.
4.5% distribution. The other, call it 7.5%, is appreciation.
Yes.
The fund itself, call it roughly $1 billion today, something like that?
Yeah, the asset value is $945 million, so we're getting closer and closer to the $1 billion mark.
Okay, of asset value.
Of asset value.
Yeah. So
typically with all real estate, there's leverage, mortgage debt.
You guys are at...
We run with 47% today.
Okay.
Our target is to be up to 65%. But really, with the volatility today in the markets and interest rates where they are, we're very comfortable being at a level that's around 50%, just in case things start to go sideways on us.
Yeah. So the market cap then on the total, it would be about half.
Correct.
Half a bill, roughly.
Yes, correct.
Okay. So you guys are strictly focused on the student housing. You said you want to consolidate. Why else would you be in student housing? Is it tell me why student housing is good.
Yeah, so if you look at Canada, we have an incredible opportunity set here. First of all, kind of base case real estate. It was a highly fragmented mom and pop sector with no professional management and no institutional capital. That creates a great buying opportunity and investment opportunity.
Okay, so pause real quick. So Because you're buying it at a discount, because you could do management efficiencies, and because you can potentially increase NOI?
Yeah, I would say we're not necessarily buying at a discount.
Okay.
I think
so that one's out, but
yeah.
you could increase efficiencies, reduce cost,
right? We can reduce
and maybe
cost,
increase rent,
and we can be aggressive on rents. What typically happens is mom and pop owners are much more focused on maintaining full occupancy. They want this to be as passive and simple as possible. They don't have the sophistication or the bandwidth or patience to push rents, to push NOI growth as much as possible. That's where we differentiate ourselves. So we'll go in, we'll buy a property, and we'll start to see, we adopt a dynamic pricing model, similar to what the airlines and hotels do, right? Where as rooms become full, the longer and longer students wait, the more they'll have to pay to secure their room. So it's a very different proposition.
Tell me about your occupancy right now.
Yeah, we're at 99% occupancy today.
That's crazy. That's crazy because I guess your lease turnover is always on the same day every year, September 1st, right?
Absolutely. This business it's actually interesting. It's not for the faint of heart, right? In any other real estate business, you have a couple of people move in and out every month, and or kind of every year. In student housing, we have about half of our turnover, half of our students. We have 5,200 beds. Almost half move out every year on the exact same day, September 1. That's our make or break day. And the problem with that is that if a bed is not full on September 1, it means the student has found somewhere else to live. And that bed's going to be vacant for the next 12 months.
Yeah.
So we really have to make sure
it's
we're
got to
managing.
be full, yeah.
Yeah, so our pre-leasing effort and cadence has to be optimized to make sure we are 100% or as close to possible being occupied by the end of August. And so I think you asked about occupancy today. Occupancy today is much less relevant. The real question should be what does your pre-leasing occupancy look like for September 2023?
Okay, well let me ask you that then.
Yeah, so we're in pretty good shape. We're almost 90% pre-leased with still 2+ months left to go before the start of the school year. And that's about 5 or 6% ahead of where we were at this time last year. So the leasing is actually even stronger this year than it was last year.
Well, I guess this is a fairly dynamic pricing model in that, or an elastic good in that you could probably fill it today if you wanted to and just charge half price, right?
Absolutely.
So there's buyers, there's a bid out there to be hit.
Absolutely.
The key is to hit the bid at the right number where you come in right around 99, 100% occupied, right?
Exactly. It's an optimization model at its best, right? Because you go until mid-August trying to keep the rents as high as possible.
Then you got to start.
Then there's that kind of that cliff where now it's getting close to
discount time.
So you got to start to make sure, because then then it's about the marginal dollar. You either get zero or you get something.
Right.
Right. So
you can't give those away at the end because then people will know that you can just give them away in late August.
Then everybody will be waiting, right?
Yeah.
So it's we got to manage the optics quite dynamically and make sure we're not starting to discount too early, but not waiting too late. It's
okay. So you guys are more occupied for incoming September than you were a year ago. What does the rent roll look like? What does the NOI look like?
Yeah. So for September 2023 to August 2024, we're targeting to do $42.5 million. That's and given that we're already 90% pre-leased, that's with 90% precision. So we feel pretty good that we're going to hit those numbers.
And what does that give you year over year?
So year over year, it's probably in and around 8 to 10% NOI growth.
Growth. NOI, net operating income.
That's right.
Net operating income growth of 8 to 10%. So the question I was going to ask you is, inflation scares a lot of people. So you guys have more costs. You guys, and that ties into debt costs, which we'll get in a sec. But higher debt costs, higher operating costs, therefore less profit. That's what most people would think, right?
Most people would think that.
But real estate is one of the key areas where you are able. When I was interviewing another CEO the other day, and their NOI had increased 8-10% just like yours. So they're more than capturing the inflation with their rent increase. Isn't that the same for Alignvest?
Yeah, and we benefit from the turnover. In most of Canada, multifamily residential is subject to rent control. So in an inflationary environment like we're in right now, families are less likely to move out of their below market rent apartments. So the landlord is experiencing a higher and higher gap to market,
right.
But it becomes harder to capture that. In our business, because we have about 50% average turnover, we just keep capturing that. If it's not this year, it's next year. So
if the student stays another year and gets the discounted rate,
if the student stays for past the first year, then we are subject to rent control,
Right.
just like multifam.
But at some point, they're no longer going to be a student.
That's right. And the way our business model works is across Canada, typically first-year students live on campus in residences. They make their friends, make their connections. They come to us for second year onwards, so second, third, and fourth. So that's our target market.
Second, third, and fourth. Okay, so I want to talk about the debt. So you guys have 500 million in debt, roughly?
About 450-ish.
450 million in debt. So that's clearly on everyone's mind when you get to real
Absolutely.
estate. It's on the front pages of all the newspapers. Real estate going to crash because Canadians can no longer afford to buy real estate because the debt's so high. It's so expensive to own real estate. So, and I get that that's a real thing for residential Canadians, mostly in large cities. How are you seeing it for you guys as a cost of debt? Or how is the debt, what's the debt maturity look like? And I know you have a nice chart on this.
So that's interesting, right? So our existing portfolio, we're in pretty good shape. First of all, we do no floating rate debt. All of our mortgages are fixed rate terms, and we have staggered maturities. When we do a new acquisition, we do anywhere from 2, 3, 5, 7, sometimes 10-year maturities on our debt. We were fortunate that in 2021, when interest rates were exceptionally low, we refinanced several of our properties and locked in very good debt at that point.
What percent of that 450 did you lock in?
We were much smaller, so let's say about half our portfolio was locked in. But the second point of there is that we also did 3 acquisitions in 2021, and we were able to put on new debt at very attractive rates, right? So, the punchline here is to your question, our average term to maturity stretches into August 2026, and our weighted average interest rate is about 3.5%. Which, compared to today, if we went to do a new acquisition today, we would be looking at upwards of 6% as an interest rate. So
you're going to 250 beeps increase if you were to buy today. If you had to roll over the entire portfolio today, 250, and what would that do to cost?
That's conventional debt, right?
Conventional.
So if we did CMHC debt, it would be in the 4.5%.
How much of this are you able to do CMHC on?
So one of our properties today is financed with CMHC debt. We have a couple of other properties that are ready for CMHC debt. CMHC debt is tricky because when you buy a new property, if there's substantial NOI growth or upside, you don't want to lock in the CMHC debt too early because it's a 10-year term.
Yeah.
So we bought a property in Ottawa in 2021, and we put conventional debt on it, and with the objective that we're going to improve the operation,
increase the value, get higher leverage,
exactly, and then go to CMHC. So that mortgage, comes up, I believe, in 2024 or 2025, sorry, and we will be taking that to CMHC.
Yeah. So I look at your debt maturity, which looks pretty good. There's a property in 2023, there's a couple in 2024, but most of them are into 26, 27, 28, and 2029. So
yes.
I guess in theory, if you can kind of wait a few years on most of these, hopefully you get an interest rate cycle that but what if you don't? What if you got to renew all of these at 6 or 5?
So look, that's the crystal ball exercise. What we do internally is model out the debt sensitivities and what it looks like. So I think one of the things that's really helpful here is our NOI has grown so much at each of these properties since we acquired them. And when the way real estate is valued is you take your NOI, divide by the applicable cap rate, and that gives you your value, right? So when the NOI has grown, and if the cap rate stays constant, that means that there's just a huge uplift in value. And when lenders look to provide debt, it's always a percentage of the value. So our current underwriting or forecasting suggests to us that unless interest rates go north of 8.7%.
8.7.
Right, and keep in mind, I just mentioned today's rate is around 6%. Unconventional. So we've got about 2.7% of buffer ahead of us. So, we feel quite confident that that's unlikely to happen. But look, who knows if inflation continues, but I think we all expect that over the next 12 to 24 months, inflation will be in line, interest rates will start to stabilize. And so unless interest rates go north of 8.7%, we feel quite confident that we'll be able to refinance our mortgages in full. And if interest rates stay at around the current levels, at around 6% or so, we'll actually have the option to increase the leverage on those properties and take out some equity. We will have very good optionality because we can then choose to take out some equity, get cash back into the portfolio, either redeploy it into new acquisitions or distribute it out to our unit holders, or we could just keep the leverage ratio at a quite low, attractive base case.
Right. So the cap rates, let's talk about the cap rates quickly. So have there been, first off, before we get to cap rates, how are these properties valued?
Yeah, so we have Cushman and Wakefield's our appraiser.
Okay.
We've engaged them to do appraisals for us twice a year, December 31st and June 30th of every year on our entire portfolio. So most other real estate firms will do a sample every year, 1/3 of their portfolio every year. We've taken a different approach where we've just said, as we're building up this portfolio,
let's do all of it.
Let's do all of it, and let's do it twice per year.
Okay.
So the $945 million asset value that I mentioned earlier, that's as of June 30th. We actually just got those appraised numbers a couple of days ago.
So they're just using NOI and cap rates. That's all they're doing.
Well, yes and no. So more recently, over the last 6 months or so, the feedback we've received is that the capitalized income approach, taking your NOI divided by your cap rate, is one approach, but it's more applicable to businesses that have stable recurring cash flows. The challenge with student housing, or the upside in student housing, makes the capitalized income approach less relevant. So over the past 6 months, Cushman and Wakefield has been also using a discounted cash flows approach, which really takes an income stream over a period of years and then present valuing it back using the applicable discount rate.
What are they using for the applicable discount rate?
It's different market by market and property by property, but I'd have to go back and check.
So how is that different? Okay, so cap rate, you're using NOI, you're using...
In simplistic terms,
you're using
your cap rate is your capitalized rate in perpetuity, right? So you're assuming your income stream is going to be there in perpetuity at a basic constant value. So if your cap rate is 4%, you're capitalizing your current NOI at 4%, but that gives you an infinite
times.
Value, right? 25 times, but it's kind of an infinite income stream, right?
Right.
When you take a discounted cash flows approach, you take your expected cash flows for the next 5 to 10 years and present value it back using a discount rate. And why they're using that approach as a second check. And why they do that as a second check is in businesses where there is variability in the cash flows, either up and down or kind of hyper growth, the capitalized income approach doesn't really value it the same way unless the cap rate is so low to account for the future growth.
Right. So you're basically saying that they need to account for a higher potential cash flow next year and in 2 years and in 3 years because we're student housing.
That's right.
We're going to capture more of the increase
than
regular REITs.
That's right.
Therefore, cap rates don't apply.
Yeah. Well, they
don't apply as much.
They don't apply as much.
So what would this is the first I hear of this. So
there's actually 3 ways, right? So there's, and I'm not an appraiser, but I'm learning all this in real time as we speak to the appraisers. You can take the capitalized income, NOI divided by the cap rate.
Which is how most multifamily real estate is done in this country.
And that's because most multifamily is subject to rent control. So they're not able to capture that gap to market in near term. Second approach is discounted cash flows. And the third approach is looking at comparable transactions, right?
Right. Which in theory should take into account those first two, right?
Absolutely. And what we're seeing in the world of student housing right now is comparable transactions are happening at exceptional values, right? And so this is where it all.
Who's buying?
Well, we did an acquisition in January of this year. Some of our competitors have done acquisitions. Harrison Street did an acquisition in Montreal at the beginning of this year. Centurion has done a substantial acquisition in Quebec City.
But it's players like you.
It's players like us.
Yeah, and do you get like the OMERs and the pension funds coming in?
No, not really. So, I think the institutional market is observing what we do. We're certainly having discussions with several institutional investor groups, but really they don't want to buy a single property.
No, they need a portfolio.
They need a portfolio.
They need what? What would their minimum be? They need like $1 billion portfolio?
$1 billion portfolio, which I think the larger the better for them. Really what they want is $1 billion portfolio as an entry price, but they want to know that there's the ability to put more and more capital to work. Right,
because they're going to get that capital constantly.
That's right.
Let's go back to cap rates and comparables. So you said that the comparables that you're seeing right now are at impressive valuations.
Yeah.
Higher than what they would be on the cap rate system, I would imagine. Traditional cap rate system.
Yeah, I think
appraisal.
Well, look, it depends on your view of what the right cap rate is, right?
Was going to be my question. Yeah. What have you seen in that first way of appraising real estate? What have you seen appraisers do for cap rates in your space in the last 2 years?
So I think
they've gone up.
The way they've gone down, actually, right? So what's happening here is that when we go, here I'll give you an example. When we go to look at an acquisition, the vendor's not stupid. They know that we're going to capture that upside in rent, if not this year, the next year, and
Yeah.
the year after, right? So they're not willing to give us a discount on the value of their building. And you know, we can't have it both ways. I can't say our business is phenomenal, we're seeing no issues, you know, no distress whatsoever. But the vendors, on the other hand, are going to be distressed, right? We're looking to buy A-quality buildings in high-quality markets, right? So for the most part, we're buying the premium or trophy assets in every market, which are performing really well. And so it's you know, it would be you know, a disconnect to say that those vendors are going to give us some sort of a discount or a deal. What the opportunity for us is to buy that asset and drive it even further from an NOI upside than the vendor was able to do.
Increase the NOI instead.
Correct.
Instead of trying to get a discount, just apply your model and increase the NOI.
Correct. And I'll give you an example. We bought a property in Halifax at the beginning of this year, right? Halifax is a phenomenal market. A multifamily vacancy rate is less than 1%. Home to, you know, several tier 1 universities
Beautiful
across.
city.
Beautiful city, right? So, you know, there's Dalhousie, St. Mary's, NASCAD. The property we bought is adjacent to Dalhousie's campus. It's surrounded by Dalhousie buildings on all three sides. We bought this building from the developer. It just opened in September 2022. It's 100% occupied. We bought this building in January, so it's not even 6 months old. 100% occupied and a waiting list for students to get in next year. So we go in, we do our due diligence, and we realize that the rents are way below market. We can push these rents 20, 30% and still be 100% full. And that's exactly how it's transpired. So, you know, as we've been in there since the beginning of the year, we've taken our pre-leasing now to 100% occupancy for September 2023, and we've pushed the rates as much as we feel is reasonable. And we believe that we'll be able to do just as much rent growth next year and the year after and the year after. And there's no other purpose-built student housing in the Halifax market. So this is the only place where students can live adjacent to campus.
How about Winnipeg? Are we on your radar?
Absolutely. You know, I've spent a lot of time at the University of Manitoba.
So did I.
Yeah, and looked at several properties. You know, we love the university. It's a great university. The challenge is it's set back quite a bit from Pembina Highway, right?
It's a bit of a walk.
It's a bit of a walk.
I used to park my car down those roads and just to get the free parking, and you walk. It's like a 20-minute walk, right?
And so we've been looking at some properties there. One of the challenges is the University of Manitoba owns the former golf course, and they just announced plans to redevelop that site. So, you know, as part of our due diligence, we have to look at displacement risk. And it's a substantial displacement risk. If we build or buy student housing on the other side of Pembina Highway, what happens when the University of Manitoba announces plans to partner with the local developer and put up 1,000 units for students?
Yeah.
And so this is something, you know, we do as part of our due diligence process, is figure out what's the displacement risk? What could be built between us and campus? Because at the end of the day, students, just like all of us, we're lazy. We don't want to walk any further than necessary, right? So, you know, we want to be as close to campus as possible, typically less than a 5 to 10 minute walk. And look, Winnipeg's cold in the winter. Right?
Winnipeg's a bit of a tough one for you guys, and maybe you'll have to just stay away because you really only have the south side there that's really walkable.
That's right.
From like that residential area in the south, which is turning into just a kind of a university hub of rentals.
Right.
But they're all houses, right? It's like traditional residential housing.
Yeah, absolutely. And then look, there's also the University of Winnipeg and Red River. You know, great schools, but a little bit smaller.
Université Saint-Boniface?
Yes, but they're smaller schools, right? Yeah. And so, you know, when we look at a school, we have to look at we have this term that we've coined, tier 1 universities.
Yeah.
And really what that is schools that have growing enrollment, ideally 10,000 or more students, and a large international student presence.
Right.
And so that knocks out a lot of the schools across Canada.
Knocks out my alma mater, Université Saint-Boniface. Okay, so the debt looks good. The properties look good. You guys are in an acquisition phase. You continue to be. If there's opportunity, you continue to be in an acquisition phase.
We're always looking at deals. We have 5 or 6 deals that we're evaluating at any given time. You know, right now we're in an interesting period though, because vendor, you know, when you asked about are we getting discounts on pricing, vendor expectations are still very strong.
Yeah, they're not selling you anything for 98 cents on the dollar.
Exactly, and you know, meanwhile the interest rates have gone up, right? So we have to be much more judicious and really focus on strategic acquisitions where we believe it's a must-have asset or in a must-be in city, right? So,
Yeah.
The acquisition we did in Halifax was an example. We really wanted to be in the Maritimes. We wanted to be in Halifax with a large enough presence where we could put a team in place so that now we have the opportunity to go right across the Atlantic provinces, right? We talked about Halifax, but there's also UPEI, Cape Breton University,
Moncton.
University of New Brunswick. And yeah, it's, there are so many nice universities across the Maritimes.
I went to Moncton. That's why
Okay, there you go.
Did my undergrad in Moncton.
Yeah, so we spend a lot of time looking at different markets. Western Canada, the prairies is very similar. We would love to be here in some scale way, but
Calgary, I'm sure, is a good one.
Calgary, yeah. So
Edmonton, there's some good.
We do have a property in Edmonton.
Yeah.
We have a small property in Edmonton that we bought as a development site. It's now been rezoned. We can put up 600 beds on a 25-story tower.
Yep.
But construction costs are still steep in Edmonton, so we're also being patient there.
Okay, so if someone's buying this asset class, what are they going to get? They're going to get 4.5% cash yield. They're going to hope to get, your target is, total return is north of 10, I would imagine?
Yeah, 10 to 12% is what we've targeted. We're at the higher end of that right now, and part of that is because of how inflation has been driving the returns.
And what would have to happen for there to be a write-down on your assets?
Well, I think a couple of things lots of stuff could happen. First of all, at the operational level, we could see softness in occupancy, right? And that could be due to some sort of rent control that's put in by the federal government, right? That could be some curtailing of international student enrollment. I think if you think about those things, are they likely to happen? We don't think so, but are they possible? Yes. So if we think about rent control, there's already rent control. We're already subject to rent control. And while we operate purpose-built student housing, the vast majority of students live in the shadow market. They live in traditional multi-res
basements,
housing,
wherever,
basements, et cetera, right? And so it would be impossible to apply rent control just to us in a harsher way than it would be to all students who live in.
What would that even look like? I don't want to give anyone ideas, but it would have to be subsidized then, I would think. Wouldn't it have to be? Because otherwise you're not going to be in business, right?
Well,
you're not going to provide housing if you're going to lose money.
That's right.
On it.
The flip side to that is if any harsh controls are put in place, then investors like us and developers won't build.
Yeah.
Right? They'll go
then
to
you
the
get
next
a huge shortage, and there's already a shortage, right?
Right. So it's a self-fulfilling prophecy, right? Everybody's complaining about the shortage in housing right now. Well, unless you can help a developer build and developers need to earn a return on their investment, right? So I think rent control it's always out there. There's always noise from the lobbying groups, but it's unlikely to happen. The second point I mentioned is some sort of drastic cut in international students being admitted to Canada. Again, look, that is always possible, but the reality is our universities are publicly funded, right? Across Canada, university education it's a publicly funded business. Pre-COVID, universities were getting somewhere around 40 to 45% of their funding from the provinces. During COVID, most provinces across Canada had to reduce funding for education as they redeployed into healthcare. So that's put more strain on the education system. The only way they can make that up...
They need to stay open. They need to charge top dollar to international students.
For international students. But the bigger risk with international students is, are we going to have a dispute with any one country and shut off the taps, right?
Right.
So the leading providers of international students today are China and India. And then there's a host of other countries that kind of make up the balance, right? I think pre-COVID, we were seeing a large inflow of students from China. During and post-COVID, that's kind of equalized out now to the point where students from India have overtaken the Chinese students coming into the
What percentage of international students make up your 100% occupancy?
So it's different property by property. At a portfolio level, it's about 25 to 30%.
Okay.
Some of our properties are 60, 70%, and some are down as low as 10%.
Okay.
It's really based on location.
Okay, so we've outlined the risk. So assuming stuff like that doesn't happen, you're managing your debt properly, you're able to continue to buy, acquire, increase NOI, clients are able to see kind of a double-digit return in the future. How does it end for them? What's the end game for my clients and for anyone watching this that ends up buying your fund?
Yeah, so we're going kind of full circle back to the beginning.
Back to the beginning.
When I talked about what we did in the self-storage
It's not what we do for TV. It's what we do for the YouTube channel. We tell a story.
Yeah. So the end of the story is, look, I like to come up with ideas, build businesses, optimize them, and then sell them, hand them off to the next buyer who's going to pay us generously for the work we've done. Student housing is no different. If you think about the natural buyer for a business like student housing, it's going to be an institutional investor. You know, in Canada, we have kind of the three groups. We have the pension plans, we have the life cos, and then we have some of the large corporate investors. And what's really, really interesting is several of the large Canadian names, the likes of CPP, PSP, Brookfield, they have substantial investments in student housing already, just not in Canada. And so, you know, this goes back to why did we get into student housing? As part of our initial research, we started having discussions with these groups. Why don't you have anything in Canada? And the answer was quite simple. They have zero interest in buying a single asset in Hamilton, Ontario. You know, they want to put to work $500 million, $1 billion, and know that there's additional capital that they could invest.
Right.
And so that's the opportunity set that we're trying to capture. We'll keep growing this portfolio as long as we can, and we'll keep optimizing the returns as long as we can. But at some point in the future, we're going to be large enough where we start to get inbound interest, and really attractive inbound interest.
What would the premium have to be for you to say yes today?
I think it's tough to quantify. You know, I think if you ask me today, we talked about the appraised value being at $945 million. You know, I think a healthy premium above that, 10% plus above that, is kind of the minimum that we'd be open to having a discussion with.
Okay.
But it's really a function of the market, right? Because at some, you know, there are many macro events that could happen. If interest rates start to rise really fast, if the buying opportunity dries up, if the future efficiencies, are less and less, we kind of have to evaluate all of that in conjunction. So, you know, I would be hesitant to say it has to be 10% more. It's a function of what's happening in the broader business and market environment.
Well, there you have it, guys. Student housing as an asset class. Sanjil Shah, managing partner over at Alignvest Student Housing, partner of ours for a long time, coming up on a 5-year number, 12% annualized return since inception. Thank you for tuning in, guys. Don't forget to like, subscribe, and we will see you in the next video.